Hey everyone, happy Thursday, April 2nd. It's a little after 10 a.m. on the West Coast, and it's time for another market update. We're dragging on with this war with Iran. Last night, the president gave a speech. There was some hope going into that there would be some indication that the war would be coming to a close very soon. So the markets kind of rally going into it. However, during the speech, there's still some confusion about how long this is going to go on. Maybe a few more weeks at the very least, it sounds like. So markets didn't like that because, again, the markets really want this to come to an end. It's affecting oil prices, which trickles down to everything else. And it's volatility. And like we talked about, the markets do not like volatility. They kind of like to know what's going on. So we really don't know what's going to happen there. It would be really nice if the markets didn't react so positive or negative on both sides anytime any sort of little news breaks, because we really don't know what's going to happen. But the markets are very narrative driven, and so it keeps having that knee jerk reaction, whether it's that the war might end soon or the war is going to go on as long as we can see. So again, this is kind of dominating the markets, dominating what's going on with mortgage rates, and until there's some clarity there or an end, basically, we're probably going to see the same kind of pattern where up and down, but mainly up. It seems like. Next thing we got. So we did get some jobs data this week. And we're going to get some jobs data tomorrow, which we'll talk about. But we got the March ADP, and this came in a little bit higher than expected. So let's take a look. Came in at 62,000 jobs created. As you can see, mostly from small businesses, and this is for the month of March. Job stayers, their pay increase stayed about the same. Job changers went up a little bit, which is interesting. And like I said, it was a little more than expected. They were expecting about 40,000 jobs created for March, and it came in at 62. However, when you look at the data a little closer, I think 58,000 out of the 62,000 jobs created were either in healthcare or education, and those are not industries that are overly affected by the economy. They're not really a good indication what if it's a strong job market or a weak job market. Those jobs just kind of exist because we always need healthcare and we always need schools. So again, higher than expected, but not coming from the strongest sectors. So again, that's the markets didn't really like that because it's a little bit hotter than expected, and like we talked about, what the Fed is looking at in normal times when we don't have a war going on is inflation and jobs. We want inflation lower, and job market shows some weakness, so that way the Fed will cut rates to stimulate the economy. So the next thing we got, we heard about February retail sales. So month of February is up 0.6%, hotter than expected. It was supposed to be about 0.4% month over month. But keep in mind, this is before this war started. And, comments, and if you look into the data, Americans are probably in the month of March started to, with the rising costs of gas and things like that, starting to tighten our belts and maybe not spend as much money on retail items because we're having to spend on necessities like gas and food and things like that. So, the longer this war goes on, the more that, starts to affect American families, the less money we have discretionary income to go spend on other things, which should have a negative impact on the economy. And luckily, the Fed seems to be aware of that. That of course, yeah, inflation, oil is going to go up and all that, but it's also going to take spending away from elsewhere, and so hopefully, they're not too aggressive thinking about raising rates and things like that. Next thing, January appreciation. So January, again, these appreciation numbers are always so dated. It seems like a lifetime ago, January. But we got the case Shiller for the month of January. It showed seasonally adjusted up 0.2%, non-seasonally adjusted without their math down 0.1%. Year over year still up 0.9%, which I think was down from 1.1 last report because there was a little bit stronger numbers last January. But again, home prices are still going up. They're decelerating. It's not going up as fast as they had them in the past, but they're still going up. So it's not depreciation. So nationally, homes are not losing value. Again, in pocket neighborhoods or in certain areas, metros, that could be happening. But nationally, things are still going up slightly. But definitely deaccelerating, which obviously has a lot to do with the economy and mortgage rates and things like that. The lower rates are, the hotter the real estate market is, the more these prices go up. So with the industry being down with higher rates, then it's not surprising that appreciation has slowed down. But again, still going up, not home prices dropping across the board, that kind of thing. Next thing. So where does that leave us? So last week we got up to 6.62%, which is depressing to say. It actually got a little bit higher than that, but over the last few days, it's actually dropped down a little bit. So we're down below 6.5, which is good news, but it's kind of depressing, like I said, to think we were just at 6%, about a month ago. It kind of reminds me of the Greek mythology, the story about Sisyphus, who pushing the boulder up the mountain or up the hill, and as soon as he got near the top, it would fall back down. It seems like our industry, that's what's been kind of happening over the last few years. Is as soon as we get to the point where it looks like rates are going to break under 6 or whatever it may be, and we're going to get some real traction, which would be good for real estate and industry and home buyers and things like that. Rates tend to go back up, and that boulder falls back down the hill. So 6.41, again, a nice little drop, but it just doesn't feel like that because we had got so much lower right before that. So upcoming, what do we got? So we got the BLS jobs report tomorrow. It'll be an important one, along with that PCE and CPI inflation data next week. But again, with the war going on, the markets have the excuse or the wherewithal to kind of look past this data because they know, for instance, inflation, it really won't have too much of the war's effect in those numbers yet. The jobs report will be very important. And again, really high or really low probably will move the markets. But if it's about as expected, which I think is about 60,000 jobs created, then we probably won't see too much movement. And then, on the horizon there, April 29th, we got the Fed's next meeting. Right now, for a second there, it went above 50% chance that they were going to raise rates at that meeting, which would not be good. We don't want to hear that. But now it's dropped down below, I think, 10%. So again, it looks like they're going to pause. It'll just be a matter of what happens going forward with this war and all this data, what they decide to do as the year goes on. But definitely disappointing, like I said, because we had gotten so low, underneath 6, and that would be good for home buyers and people in the industry and things like that. So let's hope that they figure this stuff out. And if anybody needs anything at all, please don't hesitate to reach out. Thanks a lot, guys.